Well, Paul Schulte, you make some interesting observations about Australia from afar. Tell us how you see it in this country.
Well, I think a lot of investors I talk to will say, that you have many international surveys of real estate prices for cities around the world show up not 2 but 5 cities out of the top 10 most expensive cities in the world are in Australia. And you currently have a unemployment rate of something like 5.5%, which is one of the lowest in the world right now. And also you have anecdotal evidence of wages which are remarkable. For instance, truck drivers in the mining sector getting $200,000 a year versus a similar truck driver in Chile getting 30, or in the U.S. getting 70. And so the question many people have is, why is the central bank cutting interest rates? When if you look at the situation in terms of real estate prices being increasingly unaffordable and unemployment rate being pretty moderate and wages being sky high, it seems like leaving interest rates where they are is more appropriate.
But inflation is low. It's actually just 2%.
Absolutely, right? So fair enough. You have an unemployment rate of you have an inflation rate of 2%. But so many inflation rates around the world are bogus. They include everything except the bad stuff, right? So inflation rates don't include house prices. They don't include many other issues, many other things that really affect people. They include food, tobacco, and booze. It's called the bachelor's inflation, right? Alcohol, tobacco, and food, and so there's so many other issues, including house prices, which affect your modern family.
So you think interest rates in Australia should be much higher than they are?
It seems like the interest rate structure it seems awfully low, especially given something else which is really important, and that is that the overall level of aggregate debt is exceptionally high in Australia. It's one of the highest in the world in terms of the loan-to-deposit ratio for the banks being about 120%. That would be one of the highest in the world. And so when you want to sort of slow down, credit growth and slow down the aggregates, and you want to sort of put a damper on prices, higher interest rates usually are better off than lower interest rates.
Let's just talk about China now. You live in Hong Kong, and you used to work for a Chinese bank. How do you see the Chinese economy, and in particular the credit system there? Well,
there's these things called wealth management products, which are basically glorified securitization of debt, which is basically a bank issuing a product to cover up sort of soured existing debt on the balance sheet. And these numbers have sort of, in a very stealth-like way, in a very quiet way, have been, just blowing up, beyond the imagination over the last 18 months or something like that. And so these numbers put the Chinese banks at sort of loan-to-deposit ratios, especially the smaller banks on the East Coast, at exorbitant levels, which betray the existing sort of accounting numbers that we're receiving. So the hidden leverage of China is actually causing the smaller banks to trade like the Greek banks. There's one important criteria: market cap divided by deposits. And the smaller banks in China are trading below the Greek banks. So the market is already telling us pretty disturbing information about the smaller banks in China, that they're trading at a discount to the Greek banks.
So how does that make you feel about the Chinese economy?
Well, it makes you feel like all economies run on credit, whether we like it or not. Every economy, whether we like it or not, is founded on credit. You cannot consume, you can't invest, you can't trade without credit. And what it sounds like now is that there's an awful lot of credit built up in the system, especially hidden leverage. And hidden leverage always gets you. That'll always kick you in the behind. And so this is what China is dealing with right now in terms of the hidden leverage, which is especially acute in the smaller banks. So there's going to be a long process of unwinding this.
But does it make you think that China is going to have a hard landing instead of the soft landing we're seeing so far?
I think a lot of the time that when we talk about what's going to happen in China, it's usually happening now. And so I think these GDP numbers are frothy. There might be a degree of artificiality to them, but I also think that the numbers could be dramatically lower. They could be 4%, and so we should anticipate lower GDP numbers. We should anticipate something of a hard landing on the East Coast, where the middle and the west part of the country continue to grow at pretty good pace. So a geographical recession maybe on the East Coast is what I would say.
And just finally, we hear a lot of good stuff out of America at the moment. The US economy is, you know, rejuvenating, it's coming back. Is that how it is? Really?
Absolutely. To me, you know, I focus on financials. The U.S. financial system is one of the most liquid financial systems in the world. The loan-to-deposit ratio is at 60. The American banks have pretty much cleaned up all the mess, so the balance sheets are pretty clean. The UK balance sheets are pretty clean. You know, the French balance sheets are getting better. So in terms of France, the UK, the US, even Germany, the Western engine is starting to sort of turn on again for the first time in many, many years, while the emerging market machine, I believe, is turning off.
Because of the financial system being
the credit cycle for the emerging markets, for so many emerging markets, with the exception of Africa, the credit cycle is over, and we need to wake up to that.
Thanks for joining us, Paul.
Okay, indeed.